You know, there's been so much talk about these new tariffs lately, and like everyone's trying to figure out what they mean, not just for the markets, but like for regular people too, you know. So we're going to try to break down some of the main points that are being talked about. And if you find us helpful, please like and subscribe for more. You know, Jim Cramer had some pretty strong opinions about President Trump's new tariffs. I mean, he's been saying they're worse than anyone expected. Like he thinks people were kind of getting used to the whole tariff thing, almost like a bring it on kind of attitude before the announcement. But now he's saying these new tariffs, they're just on another level. You know, he was saying that historically he hasn't been like a huge free trade guy. His whole thing was that everyone needs to be playing by the same rules. And, well, he kind of thinks the U.S. has been the only one really sticking to them. So what he's been calling for is fair trade, where like tariffs are kind of reciprocal. You know, if you put tariffs on us, we put tariffs on you. But these new tariffs, he's thinking they feel more like punishment than anything else. He actually used a pretty funny analogy when he was talking about China's trade practices. He called them a sneaky octopus. Like he was saying they've been using all these loopholes to get into U.S. and European markets. But his big worry is, you know, who's really going to end up paying for these tariffs? He thinks it's going to be American consumers with higher prices on everything. And he even suggested that the administration, they don't really care about the stock market or even like how much prices might go up for people. It's like they just want to put pressure on these other countries, no matter what it does to inflation. There's also been all this talk about a possible 20% tariff on all imports. And I mean, Cramer's been pretty vocal about that. He's been saying it could be just horrible for the economy. He thinks it could totally reignite inflation, which, you know, wouldn't exactly be great for the current administration, especially since they've been pushing this whole low inflation thing. So if inflation starts spiking because of these tariffs, it could really backfire on them politically. And then there's the whole thing about what higher prices would do to people. They might start cutting back on spending. And that could like push the economy into a downturn, especially for businesses that rely on people spending money, you know, like service industries and retail. I mean, that's a huge part of the U.S. economy, you know, with all the stock market stuff going on. Cramer's been trying to give some advice to people who are in it for the long haul. He's been saying, look, remember what happened after the 2008 financial crisis? The market tanked. But if you held on, it eventually bounced back, right? He did say, though, that if you need your money right away, like if you're retired, for example, things are kind of uncertain right now. But for long-term investors, his advice is basically don't sell, just hold. He even said his own charitable trust is actually buying more stocks right now. He sees this whole thing as a price-to-earnings ratio reduction, which, you know, could mean there's a good deal out there for people who can wait it out. So basically, he's saying if a stock's price is low compared to its earnings, some investors see that as a sign that it's undervalued and a good time to buy. It's funny, he was talking about how back in 2007, he told people who might need their money within 5 years to sell. And now he's like, that was a great call. He also mentioned how he later said people should buy after Mark Haynes, the market commentator, said things might be getting bought up. But his big point was, don't try to time the market. Like it's almost impossible to know exactly when to sell high and buy low. So where he's at right now is he thinks this sell-off, it's actually an opportunity. Like you can kind of capitalize on other people's fear and invest in companies that are going to be okay, even with these tariffs. So let's move on to Tesla, or TSLA as it's known in the market. You know, Jim Cramer has been talking about all the uncertainty these tariffs are causing. And during one of his shows, he actually brought up the Magnificent Seven, which was this group of really high-performing tech stocks. But he basically said don't even bother with them anymore because, in his words, the Magnificent Seven doesn't exist anymore. He said he made up that term himself and is retiring it now because he doesn't think any single word really describes the 2 or 3 companies that are left from that original group. He specifically said he doesn't think Tesla or Nvidia are magnificent anymore, which, I mean, that's a pretty big shift in how he sees them. But, you know, even though he's not calling them magnificent anymore, recent analysis still has Tesla ranked as the second best stock on Cramer's radar, even with all the volatility from these tariffs. The main idea there, though, is that AI stocks, they have the potential to make more money and faster than other areas of the market, like even faster than Tesla. But globally, Tesla's EV sales seem to be struggling, like they're facing a lot of competition. And while Elon Musk is definitely trying to turn things around, it's suddenly getting demand back up. It's going to be a real uphill battle. For example, in California, which is the biggest EV market in the US, Tesla's sales actually dropped almost 12% in 2024 compared to the year before. So their market share in California went from 60.1% in 2023 down to 52.5% in 2024. And what's interesting is this happened while more and more people in California were buying EVs. Over 2 million EVs were sold there last year, almost double the amount for the 2 years before. So it's not like people aren't buying EVs. It's just that they're not buying Teslas as much anymore. And it's not just California. Europe's looking kind of rough for Tesla too. In Germany, for example, they only delivered 1,429 new Teslas in February, which is a huge drop, like 76% less than the same month last year. And that happened while overall registrations for battery electric vehicles in Germany actually went up by almost 31%. So again, it's not that EVs aren't selling. Tesla's just not getting as big a piece of the pie anymore. And, you know, Tesla's product line is starting to look a little stale. Like over 95% of their sales are still coming from the Model 3 and Model Y. Meanwhile, other car companies are putting out all these new and exciting models. And reports are saying Tesla's losing market share in Europe. Companies like BMW are doing really well, and BYD, the Chinese EV maker, is gaining ground too, even with all the tariff worries. Poland-focused growth strategy, they have some interesting things to say about Tesla. In their investor letter for the fourth quarter of 2024, they pointed out that Tesla's stock price went up by 54% that quarter, and almost all of that increase happened after the election. So they're saying the market basically reacted positively to the idea of Elon Musk maybe having a bigger role in a potential Trump administration, and what that could mean for Tesla. Now, Poland, they do think Tesla has some interesting things going for it. Like they mentioned autonomous driving and humanoid robots, but they're worried about the company's current valuation. They're saying the stock price is basically asking shareholders to pay for these potential innovations now, even though they're still pretty risky and no one knows when they'll actually happen. So for Poland, that's just too much risk. They see Tesla as mainly a car company right now, and their sales are mostly limited to people with a lot of money. But I also pointed out that Tesla's having more trouble selling cars now, since interest rates aren't zero anymore. So Poland's still got a lot of questions about Tesla, like their long-term growth potential, whether a robo-taxi service can actually work and make money. And they even brought up some concerns about the company's corporate governance. One last thing about Tesla. At the time of this analysis, 99 hedge fund investors had money in Tesla. And that's interesting because some research has shown that you can actually beat the market by figuring out what the best performing hedge funds are and testing it, and then investing in the same things. So yeah, there's a lot to think about with these tariffs and Tesla. It's like a glimpse into how complicated the economy and the car industry really are. We've covered a bunch of different viewpoints on trade, the potential impact on regular people. Now, a company that used to be a star is now facing some real challenges. Hopefully this gives you a good starting point for understanding all this and figuring out what it all means for you. If you found this helpful, please like and subscribe for more deep dives. Thanks for listening.